So we had the calendar flip this year. It is obviously 2016. I think a lot of people were wishing it was still 2015 after the beatdown the markets had this week. So why did this happen? Why did this happen? Why? So the reason is as follows. We have a policy era. We are living under the age of a policy era. The Federal Reserve, in all of their infinite wisdom, found it necessary to hike interest rates in December. If you have been watching my broadcast before, you know I was the inventor of the term "lower for longer." I'll never get credit for it, but it is mine. It's that hashtag lower, the number 4, and the word longer. And the Fed kind of, for lack of a better word, I guess we're all a little salty, right? It's Friday, big market decline, screwed the pooch. They hiked interest rates into a global growth slowdown. The economic numbers that we have been, the reads we've been having are absolutely abysmal. Big firms and even the Atlanta Fed, even the Fed themselves, it's like a bum's rush race to lower GDP estimates. That isn't good. GDP is growth. When you get below 0, you have recession. Usually back-to-back quarters below 0 are considered a recession. So we are pretty close to stall speed. I've written many articles about this. They will be in the description on the rebroadcast from YouTube. I warn about a 1937 policy error where the Fed, like now, thought that there was a risk for inflation, theoretical potential inflation. The economy had shown some minor signs of uptick. They hiked rates and they caused a recession inside of the Great Depression. We are not nearly as severely in trouble as the country was then for various reasons, but that doesn't mean that things can't get pretty nasty here. So I flipped on the TV today. I got up a little earlier than usual, believe it or not. I'm a night owl. I'm up late. I'm sure if you've seen me tweeting, I'm up late, but I also rise a little bit later. So I usually wake up around 9 a.m., believe it or not. It's basically get up, check out what I see is moving in the markets, and then I start trading. So today I got up a little bit earlier to listen to these folios on TV talking about the unemployment number, the jobs number, and I actually look at the jobs numbers. These guys on TV, guys and girls, there are some ladies that are guilty of the same thing. They look at the headline number, and they say, oh, 5% or 4 something percent, and everything is hunky-dory, and the headline number was a little bit better than expected, and we had some revisions that were up. But these weren't exactly very high-quality jobs that were being given. I've in the past said that we are a nation of waiters, waitresses, carnival ride operators, all kinds of various jobs. Now, if you did a deep dive into the jobs numbers, you'll notice that most of them were part-time work, and a lot of them were for teenagers. And that was for kids on winter break who were going to work at the stores, I guess, boxing up holiday presents I guess, if anyone was even in the stores. We all know it was a bit of an Amazon holiday. Gift wrapping and doing God knows what else. And I will tell you this, a lot of people, I guess TV broadcasters, they don't really know about the real world. They know what's on a teleprompter, but I do know about the real world. And I can tell you, living in New York City, I see a lot of new construction work that is going on. There's a ton of it around me in Brooklyn, in Williamsburg, and there's a lot of it on the, you could see, actually I'm not going to pick up the thing, but there are a lot of cranes that when you come over the 59th Street Bridge you can see, and there's just a lot of construction going on. Normally, this time of year, these projects would be shuttered because of the cold weather. It has recently started to get a little bit colder, but the country has been much warmer than usual. That's been allowing a lot of these construction jobs to continue going on. They're actually putting up a building right next to me, and they are still working. It is incredible. It's actually ahead of schedule. So that has artificially, in my view, skewed the jobs numbers to look better than they are. So that is a bit of an issue. That is, someone's texting in the thing that there's no recession, all BS. That actually is not true. Let's go through some of the things that I look at to determine the strength of the economy. The non-farm payrolls, these are the Fed keys. This is what the Fed looks at, by the way. So the jobs numbers, I just told you, they're not that good. People are saying they're good, but they're really not that good. And I actually believe that given the weak holiday sales, you see Macy's is closing like 35 stores or so. That's going to be thousands of people fired. You know how many small businesses it takes to hire, tens of thousands of people? It's just not happening. The GDP, I just got through explaining to you, the Atlanta Fed cut their estimates. They know the estimates had been, even going back to last year, they had been 2.1, that was lowered to 1.9, that was lowered to 1.4, that was raised back to 1.9, and now I think they're I don't even know, it's really low. I have to check what they cut it to the other day. It might be even back to 1 point something. It's low, it's in the ones. The ISM, I love these TV guys. The manufacturing one comes out, oh, it's not a big deal, the U.S. isn't so much of a manufacturing country anymore. And then the service one comes out, and that one's a bust too. Both below 50, recessionary numbers. PMI, below 50, also recessionary numbers. The durable goods orders, I've gone on record saying this, that yes, they are okay. I think they're really atrocious, but I gotta have a little bit of a positive spin, right? We've been doing okay with autos, and we've been doing well with planes, and housing has been okay, but the problem is all of those are interest rate sensitive. And I think that some of the aircraft numbers were better because of the renewal of the Import-Export Bank. That's a whole other conversation. I don't even want to get into that right now. But autos I think we could be near peak autos. If that's the case, things are going to get a little bit funky. The Fed also looks at the dollar, which we know is still strong. I will say that the last 2 days have been a little bit weak. We're back kind of in the range, which is good. So that is a little bit takes a little bit of pressure off the market, but it has not been taking too much pressure off of oil. And then, of course, the last thing the Fed looks at is the stock market itself, the S&P 500. So I think what had happened the last time was we had the flash crash, and I think that spooked the Fed. They started talking a little less tough, and then we had that really big recovery, and I think the Fed, not being traders and not being I just think they were kind of pushed into it. They have these loose cannons, these Fed governors who just talk and talk, and I think they got so into their moral suasion that they started believing their own press, so to speak. And I believe that they got backed into this rate hike by the media, and Fed, for some reason, believed, like I said, they started to believe their own press. They believed the jobs numbers were better than they were, and they started talking about transitory levels of oil. The only problem with that is they started talking about transitory oil when it was 52 and 47, and now we're struggling to hold 33. So that's pretty wrong. I mean, listen, these guys have been wrong on their growth models the entire ride. That's actually partially why these Greece bailouts keep flaring up and then failing every couple of years, because they keep modeling all this growth for these countries, and they have none, and we have none, and the world really doesn't have that much. China and India have been sort of the growth engines of the world, and they are slowing dramatically. So that is a big problem. The issues here now, technically, let's get into the technicals. I've told you about the macro problems. They're also troubling. We have the VIX today. I had said that any close above the 25 puts crash risk on the table. We closed, I think, about 27 today. So there is crash risk for Monday. Sorry to tell you, but it very well may happen. We did close pretty underwater today. The 24-hour VWAP was about almost $23 higher. And this is basically usually a good sign for some type of a recovery, relief. So if the VIX today would have closed at under 25, I probably would have went long into the weekend. But the fact that it closed over 25, I didn't feel comfortable being long, and I think that was really what today mostly was. First of all, you had a terrible setup for today. You had this stupid gap up, which just, of course, attracted sellers. You really had the, I know that everyone thought this unemployment number was good, but it really wasn't. And I think that people just took the opportunity to take down positions. I know this morning I did a little bit of selling. For the most part of the last 2 years, I've been primarily in cash, believe it or not, after the 2013 run-up. And then I had talked about when the S&P hit the 1.618 Fibonacci extension to really lighten up and get out of a lot of longs. And I took my own advice. And it's, yes, I've missed a few moves here and there, but I do catch. I've been playing very small moves, more tactical trading. I don't have all that much on, so I've been mostly in cash, which was very good for this week. I did have some, I do have some longs on, I do have some shorts on, various whatever, just kind of trading around, waiting for more of a sign. And I think this week we may have gotten it, that the bear market in stocks could be here. I talked about trading in a very similar consolidation pattern, if you'll notice in my Sunday video. But I said we're on the wrong side of the mountain, and it looks like it is breaking to the downside. To quantify that to you guys with levels, and I will go over this, I promise, more in depth in my Sunday video because it's easier to show with the charts, but we have done a lot of technical damage to the stock market here. The first came, I had mentioned last Friday, actually in the weekend video, I said I didn't want to scare anybody, but the last time we closed below 204.12, we got a bit of a crash. And I mean, I don't know if I would say this week was a full-on crash, but it was a pretty fugly week. And we just gapped down from there. They tried to rally it. Once you took out those lows, you took out I remember I talked about those triple bottom lows. You'll see in the video I talked about those being around 199. What was this low here? It was 199.83. I said if we lost that, I thought we could have a waterfall shed event, and I think we are in the midst of that now. The good news, and there's some good news and there's some bad news, so let's continue on with the bad before we get into the good. We also, the rally after that break only got up to 201.90 basically, and then stalled. We lost 197.86, which to me was sort of the really key tail line of support. I had said if we lost all of those levels, I thought we'd see 195 and then maybe 193s. That actually held till fairly well till yesterday, and then today was just, I think today was really a lack of buyers. People were kind of waiting to see how China opens and to see if we have a crash on Monday. That sort of lets me think maybe, I'll tell you, the contrarian in me, when there's a lot of fear built up around something, we could have a gap up. Be prepared. On Monday, there could be a big gap up, and if it might catch a lot of people unsuspecting, and it could be a bit of a gap and go. I do keep that, but yeah, a lot of people I would rather, thank you, yes, the SPY levels were very accurate. I hope it saved and made people money. They really should have. I mean, if you go by the levels and you just turn off, the TV and you pick a really good, Spotify or Pandora station, you'll do yourself a lot better than you will listening to these bloviating insert expletive. So that leaves us in a very funny place here because we're below the 61.8 of the pullback low and below the 61.8 here of the flash crash low. We are on the tail end of a distribution here. We have a gap around 188.12, and just a little bit below there is a trend line. If it happened Monday, it would be like in the 188s. So that would be another gap fill. We know that the pullback low down there was 186.93. So if we had a gap down there, I'd probably be interested in buying it for a right or right out trade. I don't know that that's going to happen, by the way, but I will tell you it is very, very possible. If those lows, by the way, are taken out and we do revisit the 181.92, that to me would be. Listen, I think we're in more of a bearish position here. You know, I said it on the tape in many broadcasts before this, that the rally that we experienced after the flash crash low was a big enough and a solid enough rally to a lower high that if we started coming down again, and we're making lower highs and lower lows, that that we could really have a market top in, and it's starting to look like a really big top, and it's starting to look like that in some other big stocks too, like the Apples. So, you know, the bull market here really is in danger of kind of being kaputski. If we do rally, and I am expecting before we do get, you know, anything really, really more severe, barring, you know, I do think that Monday and Tuesday have potentially some big downside risk, but after that I do believe we would be due, considering we came down so hard and so fast already, that would be the capitulation type washout, and we would get a tradable rally after that, which I think is very playable. The problem for me is if we do get that rally, and that rally stalls, and it can't get back up above 197.86 to 199.84, let's say 200-ish, just to keep it kosher here, so to speak. I think the market is really still very vulnerable. I do expect there, like I said, those levels to maybe be retested again. We do have a big gap to fill up at 204. It wouldn't surprise me to see the market really kind of have more of a washout and then maybe rally up. But at this point, it just seems like that they're not really in the mood. Buyers aren't really materializing. China isn't resolved, and we still have a really, really large problem with regard to the Fed. I think that the Fed is going to have to, at some point, eat crow and admit they screwed it. They whiffed. The ECB had done this a few years ago, and they had to reverse policy. Trichet, I don't want to get into him. I think he will go down in history as one of the worst central bankers of all time, next to Alan Greenspan, who I think is one of the worst of all time as well. On the contrary, I have been saying I think that we had pretty smart Fed this time around. I think Bernanke will go down as one of the best Fed chairs. However, Janet Yellen, his heir apparent, isn't turning out to be quite as good. She was looking very smart, and I think she's very competent. But I think she's making some big mistakes here. I think she's a lot more political than people may realize, and I think we could be in for some rough sledding with them until they kind of right their wrong, or at least listen. If they want to save some face, I'd be totally fine with them coming out and just saying, listen. We were a little bit unsure about raising rates. You know, we were testing the waters, but simple economic conditions have worsened. The China fell out of bed or whatever. You know, however they want to. Their Kung Pao chicken came cold, and they want a do-over. So listen. They're still doing the reinvestments, which I call QE light. And I don't think it would take. And I think Janet Yellen should rein in these clowns who keep going on, giving speeches and talking tough about, still being on course for 4 rate hikes. These guys should just pull up listen, they're living in the past, so why don't they get themselves a Bloomberg terminal? Pull that up, check out what's going on, and really get with it here. They really need to get on this deflation situation. Oil is. I keep hearing people. I'm going to talk to you about oil, and I'm going to talk to you about this sort of the conundrum that's going on with what's going. Why are they doing this? I think the reason why the Fed was doing this was because they were trying to do moral suasion. They wanted to kind of calm the markets down so you didn't get a blow-off parabolic move. They tried doing this, by the way, in the 1920s, right before the blow-off top and the crash and what led to the Great Depression. And I think the Fed is trying to kind of calm the markets down. I think they're trying to. I've tweeted about this a few months ago. I said that I think that they are trying to have a controlled correction. And the danger with that, and this was when Jurassic Park was out, I said that Jurassic Park will never be safe, and the dinosaurs will always find a way to get loose. Animal spirits will always find a way to get loose, and they should be careful what they wish for, because you're starting to see some really major technical damage in the markets, and, you know, that becomes a self-fulfilling prophecy. You know, selling begets selling. You know, the weakness becomes provocative. You know, you have people who are sitting on really, who have been sitting on a lot of big gains in a very narrowing set of stocks that have been holding up the market, and they're all very concentrated in one place, and that's the NASDAQ 100. And yes, I'm talking about FANG plus Apple, which is Apple, Facebook, Amazon, Netflix, and Google, and I'm going to go through those stocks in a minute. I think a lot of people now this week finally realized that the dovish rate hike was not so dovish, and that what I've been saying all along is that it's not the amount of the rate hike that matters. It was the shift in policy from accommodation to tightening. Always in the past we had the Bernanke and then the Yellen put that, you know, if things went awry, they were there, right? They were our safety net. If we were down 15 or 20%, we knew they'd come in with more QE. Now we think they're coming in with rate hikes. I mean, it's sort of like you're down and, you know, let's give you the business again while you're down. It sort of was a bit of a head kick to the market. And I think it came at a really inopportune time. I do believe that the Fed probably should have normalized a couple of years ago in 2013. But I think they're on the downside of unfortunately, I do believe we have structural unemployment. I don't want to get too much into that here. But I also believe we have a cyclical downturn within that. So it's kind of extra pressure on the market there. So yeah, like I said, I think that the SPY probably has got a little bit more to go on the downside. It may want to rally first, but you know, until you can really get back up above that 200 level, I'm really suspect of all the rallies. I think that they could be a little bit shortable. That doesn't mean that, you know, I mean, I guess it made sense if you know, shorted into the 821 dump that Friday. You had the flash crash Monday. History doesn't always repeat itself like that, although, like I said, above 25 in the VIX, it is very, very possible. I'm not going to discount that we're not going to come into some kind of swoon on Monday, particularly if you get a big move in China again. Anyway, let's talk about oil for a minute. There's a lot of problems in the oil market, so to speak. I'm trying to, like, you know, I was imagining myself saying that, and it's kind of hard, like, almost not to laugh at, just because we know what a disaster it is. You know, the Fed is talking about they're worried about inflation, and you got deflation with oil crashing, copper crashing. You name the commodity, it's crashing, and maybe the stock market commodity might be crashing now too. So let's talk about oil for a minute. I have talked about the reason why Asia and Europe their economies had been slow is because they don't have the natural resources the United States do, and they are importers of oil. They've been very dependent on Putin and Iran and various other characters. The good news for them is that oil prices and, you know, petrol prices have come down significantly. This will help their markets eventually. It doesn't turn so fast. It's sort of like turning a battleship when you're turning an economy. So they will have some growth from this that is good. As far as the United States goes, most sectors of the economy, yes, do benefit from lower energy prices. Consumers who go in and buy things like, you know, eat out at restaurants, you know, and buy iPhones and whatever clothing, use oil and gas to heat their homes and to drive cars. So yes, there is a benefit longer term. Once those people start realizing energy prices are lower and they start using it more, it becomes more of a tailwind. The problem is that initially, when the price comes down this much, you have 15 to 17%, I have to check what it is now since it's come down so much, of the S&P being in oil and gas stocks. And when those stocks are in free fall and they're cutting their dividends, that is very bad for the market. And it's also bad for the economy in the sense that GDP, because that is a production of the United States, is coming down lower. And you have all of that upfront pain and the benefits are kind of later out onto the curve. So that is really what is happening with energy. You have the the immediate downside, and then the potential later term benefits. I had talked about this really early on, and it seems to have been adopted, that energy is being used, oil in particular, is being used as a proxy for global growth. And as long as it goes down, you are going to have these growth scares. If you can get a rally in oil, it would be good. The good news and the bad news with oil. It is hovering between 32 and 33, which is very important support. That was, I believe, the March 2009 crash low. The bad news about that is that we are producing more. There is more demand now than there was then, for sure, but we are producing a lot. We've had, a huge energy revolution here, and you also have a jockeying and fighting for power in the Middle East. The Iranians and the Saudis are basically at war. They're fighting a proxy war in Yemen right now, and they are fighting another proxy war in the oil market. And the Saudis are basically looking to fudge the Iranians and also smash the U.S. producers that have been leading the energy revolution here. They want to maintain their market share. They want to be relevant. So they are pumping, and they have a much lower cost of production than we do here, and they are not levered in their balance sheets. The only problem they really have is that they're running major deficits, but they have a lot of money. I mean, they have a lot of money stacked up, so they're gonna break these competitors here and maybe break Iran. And we all know that the U.S. has been a big ally to the Saudis for a while, and now there's been a bit of a geopolitical change with the Iran nuke deal and so on and so forth. But let's not go there. We don't need to discuss the politics. What we do need to discuss is that the OPEC, for the first time in forever, is sort of breaking. They aren't cutting productions as prices are falling. They're actually increasing production. We are the ones responsible for the decrease in production, hence the lower of the GDP. The Fed better get on this, and if they don't, they're about to see what real true deflation looks like, and I think that things could get quite nasty if they don't start waking up and smelling the coffee here, smelling the oil burning. That's what they should wake up. Forget smelling the coffee. They should just start burning oil. Anyway. That's what's going on with oil. That's what's been I wouldn't say the tail wagging the dog, but that has been what's been dictating the markets. If you look at any given point in time, there are factors that the market keys off of. At the very top of the oil market, that market, of every uptick with oil, the market would go down, and the same thing down here. I think that I have been thinking that we are trying in a bottoming process. I know Boone Pickens thinks we're going to be at $70 by the end of the year. I think that's a little bit aggressive, but I do think 50 or 55 could potentially be possible. I think that's the level that most of these companies want to kind of try to hedge some projects at, because that's where I think some of their debt covenants maybe. I know banks have been a little bit patient with them, but I don't know how much more patient they're going to be. And I think that there's going to be some bloodletting in that sector. If you want to play oil, and I have been dabbling a little bit, I've been selling a little bit of very small, not really even that consequential, but in Exxon and in Chevron, some puts, as the VIX got up pretty high, as a little bit of a nibble for a long. I do think that those companies' dividends will be fairly safe for a while. If oil stays this low for another year or so, that might change. But they are nowhere near the lows that oil are. It's actually, they look like they've bottomed a while back. Their charts are getting a little bit iffy, rolling over a bit. Chevron was getting, what kind of attracted me today was when it got a little bit closer to 80. I thought that's a level, and then Exxon in here is basically this like 75-ish, 74, 75. Between this region is sort of some support. So I think that there could be some opportunity for them. I think what they'll also have the benefit of doing is I'm not sure about Conoco. I'd have to look at their I haven't done any work on them yet. I will take a look though. What you want to look just as a sidebar, someone asked an interesting question. What I would do if you're interested in Conoco is pull up their financials and take a look at their balance sheet, their cash on the balance sheet. I would also look to see if you could figure out what the cover ratio is, and then I would look at their statement of cash flows and see how much free cash flow they have in any given period of time, so that they can cover their dividends. The only time I think that these companies will kind of cut is if they really have to. Anyway, let's go back through this. I think that these companies, and what the market is signaling, is that they have the balance sheets to snap up fire sales when a lot of these kind of companies go bust. The pipelines and all these, these wildcatters or whatever. They have some good assets, but they don't really necessarily have the strong hands to hold them. So I think that the Exxons and the Chevrons, maybe the BPs, the Totals, these big companies are going to have the deep pockets to kind of to take them out of bankruptcy or to snap them up on the cheap. Let's go right into. Let's just do FANG, right? That's what everyone wants to know about. Let's start with Apple, since it's not really an official member of FANG, but it is really relevant to the to the market. So Apple is heavily oversold. If you look at the stochastics, I mean, it's like so far through the lower band, it might be popping up in China. That could be what's causing the weakness. The good news, there's good news and there's bad news for Apple. The bad news is that the big pattern looks like it's starting to roll over. The good news is that it's into a measured move support. I will show this a little bit more on. I will show this on the on the weekend review video. We have broken trend. We had a bit of a retest, and now we've had a measured move. The flash crash low is 92. The 50% fib is 95. So we are into an area where theoretically Apple should stop. I don't necessarily. It's heavily oversold. I mean, this thing was closed. I think it was 105 last week. So you're down a pretty good amount. Also, if you draw a little bit of a channel from the pullback, with the pullback low being the lower end of the channel, that would be roughly around 92. So I have said that it's all a game of levels. I had said that below 109 was vulnerable to 107s, below 107s was to 103s, below 103 was to 100, below 100 was to 95, and we are basically there. So this area should hold. If it doesn't, you have some other important levels. The 61.8 fib, which is always a really big one for Apple, is 85.72, and the primary trend line is right below there if it happened Monday, and I don't think it will, although we might if we get a big flash crash, is 83s. It might want to grind a little and take some time, but that area is really where I think the more true support is. I would say that if you got that ahead of the number, everyone's really nervous. I will say this, the price action today in Apple was actually not so bad. I think you had 3 firms downgrade and the stock was still positive. That is what you want to see. We had a weak tape. Apple finished slightly green, and it did it with analyst downgrades. That's a good sign. It won't be enough to overcome a really big swoon in the tape, considering how much Apple is integrated into the S&P, the Dow now, and also the Qs, of course. So we'll have to see how the quarter is. I will say this: the ideal setup for Apple would be to get down there ahead of the number, and then it would probably rally on earnings on some type of a relief rally. So if they rally Apple ahead of the quarter, it's probably a good opportunity to take some off. If they dump it, hard into the print ahead of the quarter, it's probably going to be a buy. So it's going to be a George Costanza type of a play, which is always my favorite. I've labeled them, I've dubbed them the shake and bake. They shake out the stock and then they bake it back up. So that's what I'm looking for with Apple. If it rallies back up and it can't get back up above the 100 to 103, it's a short. And if it gets back down to let's say 85-ish, it's a buy. If we have a benign tape next week, I don't know that we will, or I don't know that we won't. If you want to try it, between 92 and 95, that is an area you could also use to sell some out of the money puts. So that's Apple. Let's do FANG in order. Facebook. So Facebook, everyone knows I had made the call that it would get 100 and then 109, and it actually got, it was 109.28 to be quite specific. It got over 110, and now we're pulling back. We are actually below the breakout of 99.24, so if you're long, you should probably be a little less long. We are, however, from the pullback low from the flash crash, we are at the 50% fib to the, basically almost to the tick. The 61.8 there would be 93.56. 96s and 93s were some important levels, as was 92.54 to be specific, even more specific. So in that area, there should be, if the stock is healthy, there should be some reference support. Usually what happens when you break out of a range, you can sometimes retest into the midpoint of that range, and that would be 94.77-ish. Actually, it's exactly 94.77. That was the top of the bar that led to the flash crash. So anything above there to me is still bullish, but it's a little less bullish since we're below the 99.24. The 61.8 of that move was 86.76, and if you do look back, 86s were a really key level. It was a big breakout level, and then it was a big point of support. So if there is like some kind of flash crash early next week on Monday, I would probably be looking to either buy down there for an outright long, or to sell puts, like if we got into that area. I know in the flash crash it did get to 72, which was the old peak, so maybe there's a little bit of history repeating in that situation. If we rally next week and Facebook gets back above 99.24, then it was sort of a look below and fail. Facebook, Amazon. Amazon is doing really what I was hoping it was going to do. It didn't quite get 700, but it got a new high, and it is pulling back to one. It's actually just above one of the trends. Below 619.45 is a little bit vulnerable, but my goal was for this thing to pull back hard, shake out all the weak hand chasers, and set up for a long for earnings, because I think they're going to freaking kill it for their print. So I'm sure that other people are thinking this, and they might step in, and we might not get the real pullback. I don't know how much further it would go. If you throw a fib on it, the 61.8 is 544.90. That was also sort of like just above where the breakout was, which was 542.74. So in that area, probably we'll find some reference support. There was a gap fill, 563.91. So yeah, I would feel comfortable down there. Maybe maybe playing for the put ratio, buying those and then selling further out of the money, so you could get a little bit of benefit of the downside, and then also maybe get long lower if it does happen to really kind of get the wackarooski. The trend is rising. It's just below 500 now. My guess is it'll probably be close to there, and that's roughly the 78.6. So, like I said, just fingers crossed. Just hope Amazon keeps coming down and down. Really wash this out. Maybe even get below the lower stochastic line, and really set up for a great long. To the upside, if it could get back up over the 660.64, then I would say it's probably hunky-dory. I would actually try that at this point, though, for a row short. So that would sort of be the plan. Netflix. So Netflix has been actually looking like one of the weakest of the FANG stocks, although it has used up a lot of its time from the downside. It is basically below, one of the bars is below the lower stochastic, but it actually did break. It was getting it got basically to my my end target here of like the 105s. I was really looking for 103.88 again, but 105 was enough, and then it rallied quite strong on their entering foreign markets. It got above the 115, and then it had the next day it had some follow through. I guess that was really just some short covering, and then it kind of fell apart, and now we're just like closed just below the lower trend, and also on the 100 MA. So below 115 is kind of, I wouldn't say bearish, but it's vulnerable. Above 115 is more terra firma. So if your Netflix is above 115, you want to be long. If it's below 115, you don't want to be long. Below 115, you know, the 109, 110 is really kind of in play. We're kind of close to there. We'll have to see how this plays out. I also believe that this company is doing well. It does look a little bit double top-ish, but I would love, again, the same kind of thing, the shake and bake ahead of the print. These stocks, I think, had all of them, had a lot of people who were piled in long to them, and they were long into the year end, and I think a lot of this was just now taking profits to have the extra year not to pay the taxes. Google also up high. It really got quite close to the channel top, which to me is a little bit vulnerable here. It's coming back down. I would think you get at least kind of midpoint to the channel, which would be onto the lower part. There's a kind of a channel within a channel here, and the lower part of that channel right now is about in the 680. It's really close to actually the gap fill. So 681 maybe you get. It's a little, that would be a little bit below the channel, but somewhere between like 681 and 688. That to me would be a good row spot. Again, if there's a bit of more of a steeper decline in the market, you might even you could see the channel low, which would be back closer to 600. So we'll have to see how that plays out ahead of the quarter. Again, more down into those quarters is safer. Let's go into some of the ones you guys wanted to talk about. So Shake Shack was the first one I saw mentioned. That's a bit of a problem. Anything below, I said below 41 was vulnerable, with sort of tail line support at 38.64. Not looking so good. So I don't know if I would first initiate short here. I'd probably wait for a bounce, but a lot of people are saying below those levels it could get back to the IPO price of 26. We'll have to see how that plays out. I am a little bit more bullish on this company longer term than I think most people are, but it is looking a little bit vulnerable. It really needs to get its butt back up above 41, though, to kind of neutralize and arrest this decline with some conviction. Fitbit. Someone asked about that. I've hated these stocks, just so you know, for quite some time. So Fitbit below 29.5 is vulnerable. You had that new watch they released, which looked like a complete piece of what. I guess the market agreed, and it got smacked Daruski'd. It's down on the lower channel here. It actually looked below yesterday. Today it closed just on it. I would not be shorting it here, but I would if it started to rally back up again. There was some speculation that they had a really good holiday season, so maybe if it keeps coming down or stays weak, you might nibble a little ahead of the quarter. That probably would see a bit of a relief. Let's see, JP Morgan, not one I look at all of the time, but I think that what's happening here is you have a lower high, you're retesting a swing low. I'd probably be a little bit more interested in buying JPM down in like the lower 50s, like 53, 54. There's some reference lows there. I think it really took off on the fact that people thought the Fed was going to hike and now they're kind of realizing that they're not. So that rally took place from 54.27. I would be a little more interested down there. Primary trend comes in a little bit lower, around 49s. So I would probably sell some puts if we got down into that, like those areas. BABA, we all know China is melting down. It basically got into the real breakdown area, did a lot of consolidation, and now is rolling over out of what should have been a bullish pattern that should have resolved higher. Now you have yet more layers of distribution on that area. I will say this, though. It filled the gap here to the 70.91, excuse me, and the 61.8 is around 68.36. So, if you want, you probably could do a little bit of row long action somewhere between like the 60, what was the close of this bar? 65.80. So somewhere between 65.80 and 68.36, you'll probably see some support into that area for a bounce at the very least. I would play that with put ratios for move down there if you want. Anyway, I think we covered a lot here. I think people are a little anxious to get their weekend started, and as am I. So let's wrap there. I will definitely cover a lot more of this in the Sunday video. So if you're not following me, my handle is @JustinPulitzer. That's Twitter. And be sure to subscribe to my YouTube channel, which is Justin Pulitzer Trades on YouTube. Thank you guys so much for coming. I appreciate it. And let's have a good weekend. Try and, relax a little bit. We'll stress out again, I guess, on Sunday night. All right. Take it easy. Cheers.